The Hidden Wealth Tutorial Series. Live well, keep more. Simply, safely, and effectively. How dividend-paying whole life policy loans work. When issued by a mutual life insurance company, a dividend-paying whole life insurance policy has economic characteristics no other financial product possesses. It provides internal values and enables external values at the same time. Combined, these values achieve an unmatched net rate of return. Its internal value is obtained on its own, sitting in a drawer somewhere. Its external value is obtained by how its contractually guaranteed provisions are used. The infinite banking concept, what we simply call legacy banking, is the process used to realize the external values. This video will show you how you can do that. Let's get started. First, let's review values. As itemized in legacy banking in a nutshell, the true net of a 10% gross market return is about 4.8% after accounting for costs. At a modest estimate, costs include 1% in fees, 2% in taxes at a combined state and federal rate of 20%, 1.7% in quantified down-year costs, and about 0.5% in term life insurance costs, which must be included to accurately evaluate the buy term and invest the difference approach. Now, fees have an actual cost of 1.5% or more in many investments, including 401k, 459, IRA, and similar plans, bringing the true net return to 4.3% or less. A risk-balanced stock and bond portfolio, as found in most 401k and IRA type plans, typically averages 5 to 8%. At a gross 8% after normal fees, taxes, and down-year cost averages, the true net is 3 to 4%. The money held in a bank savings account, for safety and liquidity, will further reduce the true net combined average for savings and investment returns. Net after all costs, the current long-term annual rate of return on a legacy banking design dividend-paying whole life policy from our top carrier is 4 to 4.5%, plus the lifetime death benefit. Now, this makes the net internal return, the policy on its own sitting in a drawer, about equal to a 10% gross return on market investments. By using the policy with legacy banking to recoup costs, or using leverage on the policy values to obtain other external benefits, its net return grows ever higher the more it is used, which ever widens the comparative value gap. How to do that is covered in the remainder of this tutorial. Dividend-paying whole life. Premium deposits create the policy death benefit and cash value at the same time. Now, premium deposits can be regular monthly savings and can include lump sum transfers from savings or other assets. The permanent base death benefit grows even as the cost disappears to the point of becoming fully paid up and is guaranteed for life. The cash value earns guaranteed interest for life plus dividends, a share of the company's earnings. That's because mutual life insurance companies are owned by the policy owners. After carefully regulated operational costs, all profits are shared by the owners, the policy owners, and no one else. The policy loan provision provides contractually guaranteed access to your cash value. It is money on demand to finance anything or invest in anything. If the use of the loan is for a tax-deductible expense, paid policy loan interest is also deductible. A policy loan is a collateral loan from the company's general account held as a lien against the policy values. The full amount of each loan payment reduces the lien, freeing up the cash value. With this contractual design, the policy continues to earn full interest and dividends even on the loaned amount. That can only happen because the company uses the policy loan interest that is paid to fund the policy's growth. In effect, you pay the policy loan interest to yourself. The compounding growth never stops. This provides you with the powerful benefits of uninterrupted compounding. No other financial product does this. Let's assume a policy loan is taken to buy a car. The company makes the loan and does the bookkeeping. It does not set or require loan payments. Policy loans are fully self-managed. Legacy banking mimics conventional banking. Just do what you normally do with conventional loans. By making the same payment the conventional bank would require, the full principal and interest goes back into cash value, into your own legacy bank. The costs are recouped. The principal and interest that would have been paid to the conventional bank is recouped into the cash value. Making the policy loan payments acts the same as making cash deposits. The recouped principal and interest earns interest and dividends. This recoups opportunity costs, the growth that would be lost on the money paid to banks or paid in cash. All of this adds to the total rate of return on the policy, and the money is available immediately to use again. About 20% of our primary company's investment earnings cover all operating costs. The remaining 80% goes to policy owner benefits. In the same way, about 80% of policy loan interest that is paid goes to the policy. At a 5% policy loan rate, 4% goes to reduce the loan balance, and 1% covers the operating costs. About 1% cost compared to the 4.5% or more opportunity cost of paying cash. That's why it all works the way it does. In the company owners, the policy owners' best interests. Nothing else works this way. Because the full policy loan payment, principal and interest, restores cash value by reducing the loan balance at the same payment that the conventional bank requires, a policy loan is paid off sooner. Now, by being a good banker and completing the full payment schedule into the policy cash value, the benefits of legacy banking are fully realized. Let's review the value of a legacy banking loan using a modest 4% loan as the example. Bank loans are amortized. Itemized amortization schedules are available online. Now, we often use bankrate.com. Running a standard bank loan amortization schedule on a 4% loan for 5 years, we find the true loan cost to be 9.4% per year. Recouping the 9.4% is the same as earning it. Then, by recouping the principal and interest that would have been paid to a conventional bank, the opportunity cost that would have been suffered is also recouped, all without tax. Now, this creates a net rate of return to your legacy bank. That's about triple the true net of a 10% gross market return. The longer the amortization period, the lower the payment, but the higher the conventional loan cost. The typical home equity loan is amortized for 15 years. Now, over the first 5 years, at a modest 4% loan rate, about 46% of every dollar paid is interest cost. Yes, 46%. Paying it off early does not save the higher early year costs. Legacy banking does. That is the value to the legacy banker. Most everyone would consider a 1% car loan to be a great deal. So let's compare that to a 5% dividend-paying whole life policy loan. We will compare to a standard bank or credit union car loan of $25,000 at 1% interest for 5 years. The conventional bank loan payment is $427 per month. Here is the year-by-year accumulating outlay. Each payment, 100% of principal and interest, is money flowing out of your personal economy and into their bank. $25,620 is gone forever, along with its opportunity cost, the lost future growth on all the money paid. If $25,000 cash was paid for the car, the $82,000 it would have grown to at 4% net for 30 years is lost. Financing over time is nothing more than paying cash on the installment plan with the same long-term opportunity cost effects. Now, we look at a $25,000 policy loan at 5% interest for 5 years. The payment is $457 per month, $30 more than the 1% loan. The policy loan payments are self-structured. This is the amount to pay off the loan in 5 years. Each monthly policy loan payment restores cash value. This graphic illustrates the yearly accumulating amount that is restored, recouped into the cash value, and is available to use again for any new needs or wants that may arise. For simplicity, only the policy loan payments going into cash value are shown in this graphic. In reality, the values are ever compounding with credited interest and dividends. $27,412 is recouped, plus compounding interest and dividends. The key takeaway is that each loan payment is money flowing back into cash value, your personal economy, to grow for you, to use as often as you like, however you like, and then provide tax-free retirement income later. You build and retain personal financial power, creating and controlling your capital, as you are ever recouping banking and opportunity costs, and reducing the dependency on conventional bank approval. Here's a side-by-side comparison to illustrate the difference in personal wealth with one loan. Policy loan payments flow into your legacy bank, restoring cash value, your capital. Conventional loan payments flow out of your personal economy and into their bank, gone forever. Over the loan period, we can see the loan payments accumulate in cash value or in cost. At the end of the 5 years, $27,412 is recouped, plus interest and dividends, uninterrupted compounding growth, unlimited reuse of your capital, and the additional paid-up death benefit that comes with it. Or $25,620 is gone, plus opportunity costs, the lost future growth on all of it. This graphic demonstrates the wealth difference between a true negative and true positive of over $53,032 in just 5 years for $30 a month. The payments are made from income either way. The difference lies in where the payments go and what they do for you. We need to satisfy our wants and needs for as long as we live. How we pay for them creates the difference. Which position would you prefer to be in? Legacy banking gives you that choice. In closing, let's look at a financial plan that combines safe money with using legacy bank policy loans. The legacy banker is always in charge of their own legacy bank. Here's an example of how cash values may be allocated by breaking the total cash value down into 3 sectors. Sector 1, safe money, at 4 to 4.5% net plus the death benefit. Sector 2, financing money, continuously recouping costs. Sector 3, investing money. If the decision is made to allocate cash value to a market-based investment, this is how it can work using policy loans, assuming the anticipated growth occurs. Note, cash value in the policy is fully guaranteed. Money taken with policy loans takes on the risk of whatever it's used for. Due diligence is never waived. A policy loan is taken and recorded for tracking purposes. The money is invested in whatever the policy owner chooses. There are now 2 assets, with each generating its own rate of return. The investment account has been created entirely with legacy bank cash value, with no out-of-pocket costs. The policy loan may be repaid by using the investment growth for policy loan payments. When the policy loan is repaid, there are now 2 income-generating assets. It's like cloning your money. Paid policy loan interest is deductible against taxable investment gains. The internal policy values, the interest and dividends, combine with the external values, the recouped costs, and any earned investment gains to determine the total legacy bank rate of return. By exercising the same discipline as you would with conventional debt load and debt payments, and taking the power of economics back from the banking or financial industry to work for you, Infinite Banking Concepts offers life-changing potential. Would you like to see how it would work for you personally? Email us at info@mymoneyflow.com. P.S. Legacy banking also uses the power of economics to create a better retirement experience. Our video tutorial, How to Safely Maximize Your Net Spendable Retirement Income, shows you how. Thank you.